Hello everyone, welcome back to the channel. Today we are continuing our series on the 5 keys to personal financial management with key number 4, investing. Building wealth through investing might seem daunting, but with a strategic approach, it can be a powerful tool for financial freedom. I'm going to share with you 5 essential steps to help you start investing confidently, no matter where you are in your journey. I'm so happy to have you here with me today. Let's get started. Before you start your investing journey, it's important to establish your why. With step number 1, set clear goals for your investments. When you're ready to think about investing, you should know what it is that you're working towards. Are you saving for retirement, future home, or financial independence, let's say? Different goals may call for different strategies. So if your primary goal is retirement, as an example, and you have a longer time horizon, you might choose to invest in assets with growth potential, like stocks. However, if your goal is short-term, such as saving for a house in the next several years, you might lean toward safer, less volatile investments. How about as a starting point, consider writing down your goals and including the amount you hope to achieve and your time horizon for each of those goals. This clarity is going to be a good foundation to help you get started and to guide the rest of your investment decisions. Once you've established your goals, it's time to get a sense of your appetite for risk. With step number 2, understand your risk tolerance. Now, risk tolerance is essentially how much risk you're comfortable taking on in your investments. Everyone's tolerance is different, and understanding yours is critical to building a portfolio that you can stick with over the long term. Now, you can think of risk tolerance in terms of how you'd react to market fluctuations. So if a 10% drop in your portfolio would cause you stress, as an example, you might want to invest in more stable assets like bonds. On the other hand, if you're comfortable wading through market dips and fluctuations for potential long-term gains, then stocks might be a good fit. Now, one way to determine your risk tolerance is by taking a risk assessment quiz. This type of tool is available from many financial institutions, so I would encourage you to go search for those. But these can help you gauge your comfort with risk and suggest a suitable asset mix for your personal risk tolerance level. After you've determined your risk tolerance, you can focus on developing an investment portfolio that takes all of that into consideration. With step number 3, diversify your portfolio. Diversification is one of the golden rules of investing. And by spreading your money across different asset types, you're not dependent on the success of any single investment. Now, let's say you invest in both tech stocks and real estate. If the tech sector takes a hit, your real estate investments could potentially help offset some of those losses. Diversification can also extend across asset classes. Think stocks, bonds, and alternatives like real estate or commodities. A straightforward way to diversify is by using index funds or ETFs. These funds hold a wide range of assets, and they give you instant diversification, and most often at a lower cost than buying the individual stocks that may comprise each ETF. Another potentially huge growth accelerator for your investments is step number 4, use tax-advantaged accounts. Now, using tax-advantaged accounts can make a huge difference in how much wealth you're able to build over time. Accounts like 401ks, IRAs, and HSAs allow you to grow your investments more efficiently by reducing your tax burden. For example, with a 401k or a traditional IRA, you're investing pre-tax dollars, meaning you won't pay taxes until you withdraw. Now, with a Roth IRA, you invest post-tax dollars, so your withdrawals in retirement are tax-free. And if you're eligible for an HSA, you have a triple tax advantage. Contributions are tax deductible, growth is tax-free, and withdrawals for qualified expenses are tax-free. And as I shared with you in a prior video, you want to be sure to take advantage of any employer 401k match. It's essentially free money. Also, consider contributing to a Roth IRA for tax-free growth. This is particularly true if you anticipate being in a higher tax bracket in retirement. Perhaps the most important step of all is step number 5, be consistent. Consistency is key in investing. Regular contributions, even if they're small, add up over time. You should automate your investments to ensure you stay on track without even having to think about it every month. The market will inevitably go up and down, but when you invest consistently, you're buying more shares when prices are low and fewer shares when prices are high. Now, this strategy is known as dollar cost averaging and can help smooth out the ups and downs in your portfolio's value. Why don't you consider setting up an automatic transfer from your checking account to your investment account? Even starting with a small amount, let's say $100 a month, builds in that habit, and over years, compounding interest will make a huge difference. And that's going to do it for us today. 5 steps to start investing with confidence. Now, building wealth takes time, so start small, stay consistent, and keep learning. I hope you found this information useful, and if you did, why don't you be kind enough to like this video, subscribe, and hit that notification bell so that you don't miss the final video in our series, where we'll cover key number 5, financial education. Thank you so much for watching, and I look